Hi, my name is George Dagnino. I'm the editor of the Peter Dag Portfolio since 1977. You can find more about my work on www.peterdag.com or on peterdag.blogspot.com. I'm going to talk today about stocks volatility, moving averages, and trading volume, and how they are related between them, and above all, how you can profit from them. I'm going to deal with stocks volatility and how you determine stocks volatility, how you assess market volatility, and how you can use moving averages to measure stock momentum, and then also how to use trading volume to signal major turning points in stocks. This is an interesting chart. Please note that the stock I'm selecting, which is Altria, and I'm going to talk to you more about it and what they mean, but I'm sure you will find the pattern. The moving average I'm using is the 40-week moving average. Note how since February, March 2009, the stock stayed well above the 40-week moving average. This is the first pattern. The second pattern is, note how when the stock sort of corrects for 1 or 2 months, volume picks up and the stock finds a bottom and then starts rising again. This has happened here too. Note how for 4 months the stock of Altria corrected here, 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 and here, and then finally volume rose and the stock picked up and went up again. This is an interesting thing when the stock goes parabolic and then volume increases, which tells you that there is a correction coming. This is another stock that, again, you should notice is Kimberly-Clark. Again, 40-week moving average, very rising nicely. The stock sitting well above the 40-week moving average. Notice that when the stock corrects a little bit and hits the 40-week moving average, volume increases, the stock bottoms and it starts rising. Here is the same thing, and here is the same pattern develops. The stock doesn't do much for 3 months, 4 months. This volume picks up and the stock rises. Again, keep track of the kind of stocks I am following here. Kimberly-Clark. This is another great stock. Again, 40-week moving average going nice and smoothly up. The stock is Kraft Food. And again, from 2009 to now, nicely going up. Again, when the stock corrects a little bit, strong volume tells you that this stock is likely to go up. Here for 2 or 3 months, the stock didn't do much. Volumes very strong. Stock's bottom, and the price went up. Can you see the pattern? This is a different stock. This is Caterpillar. Caterpillar is a stock that the price depends a lot about what commodities are doing and what the economy is doing. But again, before we get to that, let's look at the 40-week moving average. It shows nice and strong momentum. Notice here strong volume here, telling you that the stock was oversold. Here again, volume picked up and the stock was oversold and the price went up. What happened here? Here is the stock started doing nothing and then it broke below the 40-week moving average. Okay, this is the technical aspect. The fundamental aspect, if you follow what I write on the Peter Dag Portfolio, is that here in early 2011 the economy started weakening. The commodity prices weakened, and Caterpillar also, the price of Caterpillar came down. But look and hear what happened. Very strong, well above average volume, and this is where Caterpillar bottomed, and then the price went up. Okay, what are you saying? Is this a great stock to buy? Well, one thing you will find out is that when stocks break the 40-week moving average, momentum is broken. So the stock for the last probably close to 12 months, it didn't do much. So this is what you have to keep in mind. It's true that it bottomed, but in the last 12 months, it didn't do much. This is another stock like Caterpillar is Deere. Again, it depends. Its price depends on the business cycle. But before we get into that, notice how the 40-week moving average started moving up. Of course, when the price touched the 40-week moving average, volume picked up. It picked up in here. And then what happened? It happened that somewhere in the early 2011, when commodity prices peaked and then started going down for several months, the stock declined. So this is a stock that depends on the trends of the business cycle. And then here we go again, strong volume, the stock bottomed and prices went up. It's true they went up, but remember, they are at the level of January 2011. If you compare to the previous chart, obviously this stock is underperforming by big time. This is another stock that is really very highly correlated to commodity prices, but has another feature compared to the other charts that I showed you, is very volatile. Look how volatile it is relative to the moving average. It goes up and down and up and down. So this is a stock that is not for the long-term kind of investor. Again, they went up about the 40-week moving average, but when it breaks the 40-week moving average, it tells you that momentum is broken. High volume, it tells you that there is a bottom. The stocks went up, but again, in early 2011, commodities peaked because the economy slowed down because of the indicators that we discussed in the Peter Duck portfolio, and the stocks kept on going down. This is not the kind of stocks that you want to invest when the economy slows down and when commodities decline. Here, the other pattern that is important, volume picked up, you know that this is a bottom, and the stock went up. Now, should you invest? Well, keep in mind that the stock, as we said, is at the same level as January 2010. So for 2 years, this stock just did not do much in uncertain times, economic times. If you compare to the previous stocks, you probably have to decide which ones are better, this one or the previous one I showed you. This is a very important chart because it shows you volatility, which is the VIX, the volatility of the market, compared to the stock market. The stock market is this chart here on the top. Notice how when volatility is high, like in early 2009, and then in 2010, and then in September, October, November of 2011, the market here bottom, here it bottom, and here it bottom. In other words, when volatility is the highest, the market is likely to pause. Now, what volatility measure is how much nervous the investors are. So if the investors feel more complacent about the market, more comfortable about the market, and volatility declines, the odds are that the market is going to rise. When, again, here it happened in 2009, it happened also in 2010. Volatility declined, the investor became more comfortable with what they saw, and the market went up. Here, volatility declines, the VIX declined, investors became more comfortable with the environment, and stocks rose. The time to worry is when volatility rises sharply because they see problems ahead, and investor becomes more concerned about the outlook of the market. So it looks like when volatility is declining or is very low, like here, or like here, investors feel comfortable about the outlook of stocks, and they invest and bid the prices up. Thank you for reviewing this presentation with me, and hopefully you found it very useful. For more information about how stock market sectors are related to the business cycle, please go to www.peterdag.com or on peterdag.blogspot.com. Thank you, and see you really soon. So long.